I have spent last few months obsessed with the question, if financial crashes are so obvious in hindsight, why do 90% of the people get wiped out right in the moment? To figure things out, I decided to tune out the pundits in the news and took a step back in time, 150 years back to be exact. What I found wasn't a secret formula, but it was a repeatable pattern. It's a five-stage sequence that appeared before the Panic of 1873, the Great Depression, and the 2008 collapse. Most people wait for a trigger, some big news event to tell them when to sell, but by the time the trigger happens, it's already too late. Therefore, we need to look at the architecture beneath the market. Today, I want to walk you through the four invisible stages happening right now that points to a major shift in 2026. This is not about being an expert, this is about being a student of history. In 1929, there were two men with very different ideas. Irving Fisher was the most famous economist of his time. He told everyone that stock had reached the permanent Y plateau. He was the ultimate expert. But then there was Roger Babson. Babson wasn't academic. He was a statistician who looked at patterns. He warned a crash was coming, and the paper actually mocked him for it. Therefore, when the market collapsed 47 days later, Fisher lost everything and died in poverty. But Babson, he made a fortune. Babson survived because he ignored the hype and focused on five specific factors: credit, concentration, insider behavior, liquidity, and trigger. Let's look at stage 1 because it is the loudest warning sign we have today. Stage 1 is the credit explosion. Think of credit like oxygen in a room. When there are plenty of it, the fire of the market burns bright. People borrow money to buy assets, which pushes the price up. Therefore, they feel wealthier and they borrow even more. In 1929, people are buying stocks with 90% borrowed money. In 2008, it was no money down mortgages. But look at where we are at today. Between margin debt, corporate debt, and America's $36 trillion national debt, the total leverage in the system is higher as a percentage of GDP than it was during the Great Depression. We have pumped so much air into this credit balloon that rubber is starting to thin. But a balloon can stay inflated for a long time if it is supported correctly. And that's why we have to check stage 2, the concentration. Imagine a forest. A forest thrives on biodiversity. A market thrives on its breadth. Currently, the American market is in a concentration trap. Just 7 stocks, the Magnificent 7, now make up to 30% of the entire S&P 500. If you own a diversified index fund in your 401k, you aren't actually diversified. You are standing on a narrow platform held up by the 7 pillars. Therefore, if just one of those companies like Apple or Nvidia misses an earning report, the entire index drops. This creates a momentum machine. On the way up, the index funds are forced to buy more of these 7 stocks. But on the way down, they are forced to sell them first, which accelerates the crash. The smart money sees this narrow base and they have already started their exit. And this is the part that usually makes most people frustrated. In stage 3, the smart money, like the CEOs, the billionaires, the institutional bankers, quietly reduce their exposure. In 1929, the Rockefellers, the Morgans, started selling in the summer, months before the October crash. They didn't go on the news and tell you to sell. In fact, their public statement often encouraged people to keep buying. Today, the corporate insiders are selling at a historic high. For every one insider buying their own stock, multiple insiders are dumping it. But while they sell, the retail investors are still pouring money through Robinhood, through passive index funds. History shows us that the regular people often become the exit liquidity of the elite. They buy at the top so the billionaire can get out. And that brings us to stage 4, the liquidity illusion. Liquidity is the oxygen of the financial world. You don't notice it until you are gasping for air. The Fed has raised the interest rate at the fastest pace in 40 years to drain the money out of the system. For a while, the market stays high because of the momentum. But underneath the surface, the plumbing is broken. We saw this in March 2023 when 3 major banks failed in a single week. The Fed stepped in with emergency patches, but those are temporary. When liquidity disappears, the market don't just go down, they gasp. They go into free fall because there is nobody on the other side of the trade to buy your shares. This brings us to the final match, the trigger. The trigger is the match that lights the fuse. In 1929, it was a minor fraud case in London. In 2008, it was the Lehman Brothers. The trigger doesn't cause the crash. It just exposes the fragility we have been building from stage 1 to stage 4. It could be a commercial real estate collapse, it could be a geopolitical event, or a sovereign debt crisis. But here's the timing. Historically, once all 4 indicators flashes red, which happened for us in 2024, the collapse usually follows at 12 to 24 months. Therefore, our window is maxing out by end of 2026. And I'm not a financial advisor. I'm just someone who looks at this pattern and gets uncomfortable when the expert says it's different this time. Roger Babson didn't panic, he prepared. He held cash, reduced his concentration, and bought hard assets. He respected the architecture of the market. You don't have to be a genius to survive what's coming. You just have to be willing to see what other people choose to ignore. I bring these type of videos to you after doing a lot of research, so I would really appreciate if you like. And if you're interested what is coming up next, then please don't forget to subscribe. See you in the next video.